Financial institutions have arguably a privileged position in the economy as both a visible provider of capital and a protector of financial system stability. It does this by working with governments and financial sector regulators on an ongoing and, more important, extraordinary basis to fulfill commercial and social objectives. But this relationship is not one-directional. It is two-way. Regulators and the government expand capacity of financial institutions to provide capital to the economy in times of need, so that financial institutions can support the economy and its economic growth. And we only need to look back to the COVID-19 pandemic of a few years back, when banks were arguably in the center of the pandemic, one, as the recipient of government support and regulatory forbearance, and at the same time, providing liquidity to the economy at a time when other capital providers decided to exit. But with this privilege or power comes responsibility, and we have seen that when financial institutions work against the government and financial sector regulators, likely due to commercial objectives conflicting with implied social ones, then financial institutions invariably feel the regulatory and reputational consequences. So this highlights financial institutions' critical service, high systemic importance, and result in strong regulatory oversight from the pervasive influence of financial institutions on society. It is therefore no surprise then that their influence on sustainability is also pervasive, or that environmental, social, and governance considerations in turn also heavily influence the activities of financial institutions. In fact, we believe that financial institutions have a compounding influence on sustainability and environmental, social, and governance issues, and that the influence of these issues are highly interconnected for financial institutions. Environmental considerations for financial institutions seem simple at first glance. They're Scope 1 and Scope 2 emissions that are not as complex as can be for other industries. However, it is their exposure to Scope 3 emissions that are of most impact, those emissions that financial institutions indirectly affect in its value chain through the course of doing business and providing loans. According to the Carbon Disclosure Project, or CDP worldwide, financial institutions' greenhouse gas emissions that come from lending, underwriting, and investment activities are on average more than 700 times higher than their direct emissions. Financial institutions are positioning to be the leader in the world's transition to a low-carbon future through their influence on Scope 3 emissions, and that is twofold. Firstly, in the disclosure of the quantum of their financing of emissions-generating activities and their steps to reduce this, i.e. limiting negative environmental impacts. And secondly, their activities to assist in transitioning to a low-carbon global economy, i.e. enhancing positive environmental impacts. So there are two key initiatives that seek to improve the progress of these activities. First is the Net Zero Banking Alliance, or NZBA, where members of the alliance have signed a commitment statement to, in summary, have their lending and investment portfolios align with pathways to net zero by 2050 or sooner through setting intermediary 5-year targets from 2030 or sooner to 2050 for lending to certain priority sectors where the bank can have the most significant impact, i.e. those most greenhouse gas intensive sectors within their portfolios. Success of these targets will be published annually. This leads us to the second key initiative towards net zero, which deals with disclosure, Sustainable Finance Disclosure Regulations, or SFDR, that represents an important development for the accurate monitoring, reporting, and disclosure of these actions to 1. Improve the quality and consistency of sustainability-related disclosures. 2. Promote responsible and sustainable investments. And 3. Discourage greenwashing. First introduced in 2019, the SFDR, broadly speaking, establishes mandatory disclosure regulations for asset managers and other financial market players on how ESG or sustainability factors and risks are analyzed and integrated in the investment process for ESG-related products at both the entity and product levels. While SFDR applies to financial market participants based in the EU or those outside the EU that market to EU clients, SFDR likely provides a template for the implementation of other sustainable disclosure measures globally. And we expect the impetus for this to grow, particularly as the urgency surrounding key sustainability issues rises. Now, while net zero commitments and reporting highlight how financial institutions can influence the environment now, another key influence is how the environment can impact financial institutions as well as the resilience of the financial system in the future. Climate change leads to increasing instances of severe weather events, and these events can negatively impact financial institutions' capital position and solvency by affecting their investment and lending portfolios, weakening borrowers' ability to service loans, and also impacting the collateral that supports these loans. To address this, regulators are increasingly putting in place formal requirements for financial institutions to assess climate risks and to adequately disclose these risks, and so as to incorporate them into capital adequacy assessments. This is encapsulated in the concept of a climate-related stress test, an idea that came from the recommendation of the Task Force on Climate-Related Financial Disclosures, or TCFD. What are some of the implications as a consequence of the stress test results? Number one, higher costs from disclosure obligations. Number two, higher capital requirements if exposure to transition and/or physical risks are elevated. Number three, financial institutions may be forced to change the way they do business. Number four, business segments may be de-emphasized where adequate disclosure of ESG-related data is challenging. Number five, mandatory disclosure of heightened ESG risks may drive capital and investors away from certain financial institutions when they need it most, thereby creating higher credit dispersion and less competition. And this may ultimately raise costs for consumers and undermine financial sector stability. The main products of financial institutions, bank accounts, loans, mortgages to retail and corporate customers, some of the most widely prevalent and used products in today's world. Financial institutions have long been relied upon to safekeep our money and personal information and protect countries and their economies. Aligned with this are long-standing social considerations or obligations, and these social sustainability factors, in our view, present a high influence on financial institutions. Remember, banks have a business model built primarily on trust, so it is crucial for financial institutions to constantly monitor and manage social sustainability influences so as not to jeopardize the trust that society places in its financial institutions. Some of these social influences or risks are enshrined in regulations, and the regulatory or financial consequences of financial institutions not complying with them are evident. Some of the key social influences that surround financial institutions today through its provision of financial services are financial inclusiveness that is positively associated with GDP growth, maintaining confidentiality of client information, protecting against internal and external fraud, avoiding mis-selling of financial products, changing consumer preferences, and finally, monitoring and reporting anti-money laundering and terrorist financing. So given financial institutions' critical service and high systemic importance, there is a need for strong regulatory oversight. And combined with the business model built primarily on confidence and trust, governance influences on financial institutions are enduring to ensure there is an appropriate corporate culture and adequate risk management and financial strategies so that financial institutions' higher business risk can coexist with their systemic importance. Governance influences for financial institutions are both internal and external. Internally, financial institutions have mostly independent boards and committees that are becoming increasingly focused on sustainability impacts on the banks in which they are involved. And they are increasingly becoming experienced and incentivized through KPIs to meet sustainability agendas. Externally, governance influences are through regulatory oversight, given that, in the words of the Monetary Authority of Singapore, governance weaknesses at financial institutions can result in the transmission of problems across the finance sector and the economy. They may not only undermine public confidence in that particular financial institution, but the financial institution and markets in which it operates as well. Governance influences from a sustainability perspective for financial institutions is therefore high in our view and will likely grow again as the importance of sustainability increases. That said, we believe the high influence of governance sustainability factors acts to effectively manage the influence of environmental and social sustainability factors on financial institutions. As such, while there is a compounding or amplifying influence from environmental, social, and governance, or ESG issues on financial institutions, paradoxically, we actually believe that the quality of each of these influences offsets the collective quantum and reduces the overall sensitivity of financial institutions to sustainability for the time being. Thank you for listening to our views on the amplifying influence of sustainability on financial institutions. Please look out for further videos on sustainability. Thank you.